All right. So we're getting started with Chapter 4. Chapter 4 starts with the trial balance of Lorry Rental Agency on March 31st. They give you the trial balance. They provide you with some additional information. And we are asked to journalize the adjusting entries at March 31st. Okay? We need to journalize the equipment depreciates at $500 per month. So, we are doing adjusting entries. You have to determine whether what we're looking at is an expense or a revenue. If it's an expense, we know the first debit will be for an expense. Okay? So the equipment depreciates at $500 per month. This is an expense. This is for depreciation expense. So the first entry we will see is for the depreciation expense for $500. And where it's debited for depreciation expense, the credit is for accumulated depreciation. Always, this would be the journal entry. Depreciation expense, accumulated depreciation. Okay? And it's just for the amount 500. 2/3 of unearned rent revenue was earned during the month. Okay? So you look at the unearned rent revenue account, it has $9,000 in it. It said 2/3 of the $9,000 was earned this month, so that would be how much? Yes, $6,000. So when you look at the journal entry, just like I have already written down there for unearned revenue and service revenue, you'll see the amounts, $6,000. Okay, and they show you the calculation underneath. It's just 9,000 times 2/3. Okay? If you have a question, make sure you just raise your hand and stop me and we can talk about it while we go through it. C. Consulting services earned during the month but not yet collected or billed to clients amounted to $1,500. The not yet collected or billed is a hint that this is an accrual. Okay, we have not billed them, we have not collected it. So we did not touch the cash related to it. So in that case, it's recognizing revenue. It's an accrual. It's going to be just like the journal entry. Accounts receivable is a debit. Service revenue is a credit for the same amount of $1,500. Okay? Supplies on hand total $800. We have the journal entry there. It's going to be a debit for supplies. It's going to be a debit for supplies expense and a credit for supplies. And the amount of the difference between the owed supplies balance, $2,000, minus what they have on hand, the $800. So $2,000 minus $800, and that's where we get the $1,200 supplies expense. Okay? And E. A one-year insurance policy was paid for on March 1st of the current year. So as a one-year insurance policy is paid for on March 1st, that means we take this $3,000 and divide it by what? 12. Okay? You take your $3,000, you divide it by 12, and you will end up here with $250 for your insurance expense and prepaid insurance. Okay? Are there any questions on these adjusting entries at all? Okay? Just try to keep in mind that there is no cash involved with an adjusting entry. There's never cash involved, so you'll never have cash. It will either be an expense and some asset account, or to be an expense and some liability account, which is likely accounts payable or salary and wages payable if you're recording salary and wages at the end of a month, for example. If it's revenue, it'll either be a deferral, means it's recognizing revenue now and taking it out of a previous liability, whereas an accrual is recognizing the revenue now and putting it into an asset that we expect to collect later. Okay? Generally, you just want to memorize the two journal entries that go together. Accounts receivable, service revenue all the time if it's a sale on account. unearned revenue and rent revenue anytime we're recognizing previously collected cash. Okay? Any questions so far? No? All right. We're going to scroll down. Number 2 is a different problem. Did you have a question? What's up? Okay, keyword when we're doing that is consulting services earned during the month, not yet collected or billed. No money has been collected. So this is money that we've earned, but we haven't collected it and we haven't billed anybody. So that's just work that we've completed. Okay? So it's work that we've completed, so it's considered service revenue because we've completed the work. And now that we've completed the work, we can expect to receive that money. So we open up an accounts receivable to tell us how much we can expect to receive. Okay? So the key word there when you read it is not yet collected or billed. All right? Okay, so question number 2 gives us another trial balance. And it says journalize the year-end closing entries. Okay? Closing entries are the entries we make to turn our revenue and expense accounts to 0. Our revenue, our expense, and let me say one more, our dividends account to 0. Okay? So what it means is we're going to take whatever our revenue account is, it's a credit, we're going to debit it. We're going to look at all our expenses. They're debits, we're going to credit them. And the difference between these two amounts, that net income that we would have, gets credited or debited to retained earnings. Just like how it flows in the financial statements, it goes from an income statement, the net income goes into your statement of retained earnings. You add net income, you subtract dividends, that gives you your ending retained earnings amount. It's all done through a journal entry. It just shows up on the financial statements as a pretty presentation. Okay? So what you do here is, just like I said, we're going to debit our revenues and we're going to credit our expenses. The difference will either be debited or credited to retained earnings. Okay? That's the first entry we make. The difference here was a credit for $9,100. What does that mean? Can anyone tell me? We had net income of $9,100 and we're crediting our retained earnings because it moved it up by that amount. Okay? If we go back and look at the question, we also had dividends of $5,000 that were paid. Okay? This dividends is debited on the trial balance, so I know that I have to credit it when I'm doing the closing entry. So here underneath it, right there, retained earnings dividends. That's the reduction in retained earnings for the dividends, just like you see on the statement of the statement of retained earnings. Okay? Any questions on those or anything on chapter 4? Anything in chapter 4 you might have a question on? Okay. All right, so we're going to move on to chapter 5. Chapter 5 is fraud, cash controls, and the big thing on it is the bank reconciliation. Okay, what's a reconciliation, anybody? No, just in general, not what's a bank reconciliation. What's a reconciliation? Have you ever reconciled with anybody? No? Well, something, somewhat. I mean, what do you mean by accounting for what you have? A reconciliation, very simply, is an agreement. When you reconcile with somebody, you come to agree. A bank reconciliation is getting your cash account, your cash books account, to agree with your bank book account. That's what you're trying to do. So in that, you try to put everything that's in your bank onto your books and everything that you have on your books onto your bank account. And that's the process. So we start off with each ending balance that we have. So we'll have the cash balance per July for the bank, and we'll have the cash balance for the books. Okay? From there, we make the adjustments to either side in order to come to that reconciled amount. Okay? Now, the way it's stated on here was very straightforward. cash balance per bank, and then it said July bank service charge not recorded by the depositor. Does this need to go onto the books or go onto the bank? And will it be positive for that side? This would be a negative for the books, right? Cash balance per books is the cash balance. We just put both of those in there. That is, so this would be the bank balance, right? This would be the book balance. All right? So now let's look at the next one. The bank charged two guys account $350 for a customer's NSF check. Would this be a negative on the books or on the bank? The books. If it's an NSF check, that means the bank received it and it bounced in the bank. So that means the books have to adjust for that. Okay? So this is going to be minus on the books. Deposit in transit, July 31st, 2200. Does this affect the banks or the book? The bank. These are deposits in transit. Deposits in transits are deposits or monies that you have recorded as receiving but have not made it to the bank. Okay? So this is a positive and this is for the bank, right? Okay. EFT deposit. Bank collected $1,266 account receivable. So this is positive for the books. Positive for the books. Outstanding checks, July 31st, $594. It's negative for the bank. Outstanding checks are all the checks that I have written, but people have not cashed yet. So when Friday comes and you write all your employees' checks, you say that you've written out you've paid your employees $20,000, but only 3 people went to the bank. So your bank says you only paid out $1,500. You have to make the adjustment so you don't forget that you paid these people and you don't have that money. So this would be a negative to the banks, to the bank. Okay? And this is all you do, and then you go to you create what we do here is create a worksheet. We put our bank information on one side, put our book information on the other side, and we even them out. So when we start off with the bank statement, 7363, we get from there. And then let's look at the bank adjustments. We add 2200 for the deposit in transit. We subtract the 594 for the outstanding checks. That gives us 8969. We go to the book balance. Book starts off at 8075. All right? Then we have to add in this $1,260 account receivable. We subtract the 350 NSF, and we subtract these service charges. Okay? Add the EFT, subtract the other two. These should look like this. I'm sorry. Just to make it a little bit easier for you to know. All right? And the total will end up being 8969. So that is your true balance. That's how much money you have in the account when everything clears through the bank. Okay? Any questions on the bank reconciliation? Now the last part of it, journalize the adjusting entries for July 31st on the books of Two Guys Video Company. Which transactions need to be adjusted? Which numbers? Okay, so which numbers? Two, 4, and 6. 6. 2, 4, and 6. Because 3 is the book balance. There's no adjustment for that. So we have to adjust for the service charges. We have to adjust for the NSF check. And we have to adjust for the EFT. Okay? And that's what we're going to have right here. So the first adjustment was for the EFT deposit. It goes in the same order they show here. It said right here, collected 1266 account receivable. Okay, and it will always be accounts receivable when you're collecting. Cash, accounts receivable. Okay? We have the service charge, which is the office expense. Bank charges are office expenses. That's it. We don't have to make a bank service charge for it or anything like that. They're just office expenses. Okay? And then the NSF check. The NSF check is reducing or putting back the amount into your accounts receivable and then adding back, reducing your cash because you don't have that money. You thought you received that money from a customer, but the bank lets you know that it was a bad check. So what you're doing is saying, oh, this customer still owes me the $350, and I no longer have that money in that check that he gave me because it was no good. Okay? Any questions? Okay. Chapter 5, question 2. Chapter 5, question 2. A petty cash fund was originally established with a check for $150 on October 10th. The petty cash fund was replenished when there was $425 remaining, and there was petty cash receipts for postage, $43.50, $51.85, and equipment repair was $49. Prepare the journal entry, if any, required to record the replenishment of the petty cash fund on November 30th. Why did it say if any? Because you don't what? Because you don't record the individual spending of your petty cash money. So when you actually pay the lawn man, you will not record it then. But when you replenish that petty cash fund, you will make the adjustment. Okay? The petty cash fund adjustment is just where you will just recognize the expenses for their amounts, and you will record the reduction in your cash for the amount that you're going to put into the petty cash fund. If they do not equal, you will either have a cash shortage or a cash overage account. If the cash is short, if the expenses are less than how much you're putting back, it's a cash shortage. If the expenses are more than what you're putting back, it's a cash overage. So if I had expenses of $100, but I only put back $90, I have cash overage. Okay? If the expenses were $100 and I have to put back $110, I have a cash shortage. Why? Because I should have only had expenses of $100, so I should only put back cash of $100. That's the example of what we're doing here. You want to add up your expenses, cash receipts for postage, supplies, and equipment repair, $43.50, $51.85, and $49. And then you'll compare it. If there's $425 and there was $150, that means I have to put back $145.75. Okay, I have to put back $145.75. How much are my expenses altogether? My expenses altogether are $144.35. So I should only have to put back $144.35. But I have to put back, what did I say? $145.75? That means I have a cash shortage of $1.40. Is anybody confused? You good? Okay. So this is the journal entry you're seeing now. The $43.50 is for the postage. Okay. This is supplies. Please remember that when you're buying supplies, you would record it as supplies and not supplies expense. And the repairs and maintenance expense, and then there's a cash shortage of $1.40. And then that will make it all even when we put back $145.75 to replenish our petty cash fund. Yes, sir.
Why is it not supplies expense?
Okay, because supplies, whenever we buy supplies, we put it into the supplies account, and then at the end of the period that we're accounting for, we go ahead and count our supplies on hand and do the subtraction for that period to determine the supplies expense. Because otherwise a person could go out and spend as much money as they wanted on supplies and record it all as a supplies expense. and they could hold on to it for 30 years if they needed to type thing. Yeah. Okay? So, any questions? Okay? How do you feel about chapter 6? You say? That? Which one? Chapter? Okay. All right. Chapter 6. Okay. Chapter 6, rear office supply uses a perpetual inventory system. During September, the following transactions occurred, and they want us to journalize, calculate the net sales, calculate the gross profit, and calculate the gross profit percentage. Okay. So the first event, September 6th, we purchased calculators from Danny Co. for $1,400 terms 315, net 30. What other terms? Okay. Otherwise what? Just deal within 30. So 3/15 n/30 means that that you will receive a 3% discount if you pay within 15 days. Otherwise, the net amount of your balance is due within 30. Okay? So for September 6th, purchase 70 calculators from Danny Co. for $1,400, term something. At this point, we do not care about the terms. It is a purchase. We purchased it with terms. That means we purchased it on account. So if we purchased it on account, that is simply a debit for inventory and a credit for accounts payable in the amount of $1,400. How much we intend to pay if we do not take advantage of the discount. Okay. September 10th. Returned 5 calculators with a cost of $100 to Danny Co. that did not meet specifications. So they returned calculators back to Danny Co. All that means is, when it's a purchase, my inventory gets reduced and the amount that I owe them is reduced. Okay? So that means it's just a reversal of the purchase for the amount. I'm going to reduce my accounts payable for $100. I'm going to reduce my inventory for $100. When it's the purchase return, you're just inversing the earlier entry. Okay? On September 12th, sold 30 calculators for $900 to Great Big Bookstore, terms 2/10 n/30. The calculators cost $600. Still the same way, we are making a sale. The terms make no difference to us at this point. The terms matter when we make the payback or we receive the payment. So right now, we are just worried about selling calculators for $900 to the Great Big Bookstore. If we sell on terms, that means we sell on credit. So that means we make the assumption, or we know that the journal entry will be accounts receivable, sales revenue. That's the first part. Every time you have a sales transaction, you will have 2 journal entries to perform. The first part is recognizing the sale. The second part is recognizing the cost of the goods sold, or the cost of the inventory. So that's what you're going to see here, and that's why it tells you the calculators cost $600. So for these calculators that cost me $600, that's the cost of goods sold, $600, and it reduces my inventory because that's how many I sold. Okay? Any questions so far? No? Okay. September 14th, granted credit to Great Big Bookstore for the return of 5 calculators. It was a sale price of $150, but it cost me $100. So that means I have to record the reduction in the sales in the amount that they owe me. Okay? So to record this reduction in sales, I know that they don't owe me as much, so I'm going to reduce the accounts receivable by $150. But because this is a sale, instead of just reversing sales revenue, we don't do that. We go ahead and use these sales returns and allowances, okay, which is a contra account for sales revenues. And so we just recognize that they do not owe us the $150, and we called it a sales return and allowance. At the same time, we must recognize a reduction in our cost of the sale. Okay? So that inventory they returned, it goes back into our inventory, and it is taken away from the cost of goods sold because we did not actually sell that. It was returned to us. Okay? September 21st, paid Danny Company for the September 6th purchase within the discount period. Okay? So they paid for the purchase within the discount period. All right? We are making the payment for this purchase. Correct? We returned $100. We bought $1,400 worth. So we owe them how much altogether still? We owe them $1,300 still. We are recognizing the paying off of this. All that means is I'm going to be paying cash, credit cash. I'm going to be paying these off, so that's going to reduce my accounts payable. Okay? Now, the idea is, and the reason why we make this journal entry is that you record inventory at its cost. So when you purchased it, the seller was going to collect the full $1,400 if you did not pay within the discount period, right? So that's what you recorded it as. But because you took advantage of that discount, you can now tell yourself, well, that inventory didn't cost me as much. So the way it works is you paid off $1,300. That goes away. You're paying off the account. Okay? You're going to take advantage of the discount. That discount reduces the cost of your inventory. So your inventory takes that amount. And the amount of cash you pay is the difference. Okay? And that's just how it works. You just say the percent, the discount, that reduces your inventory. The full amount, you're paying it off. And you get the difference between how much it was and how much of a discount you received. And that's how much you pay for cash. At the end of chapter 6, there's a small exhibit that compares the purchaser and the seller's journal entries for these transactions. I would recommend just making sure you memorize those. That would be the best thing to do because it's always going to be these journal entries. It's not going to change when we're doing sales and purchases. You just want to make sure you're comfortable with knowing what it is on a sale, what it is on a purchase. So the last one, receive payment from the great big bookstore within the discount period. So we received a discount or payment from them, and they also paid within the discount period. So what does that mean? That means the accounts receivable that they owed us is going to go down, so that's going to be a credit. We received cash, so that's going to be a debit, but we also gave them a sale discount. So we're going to debit that account. And that's how it is. It's just, so we say we sold them $900 worth of goods originally, but they returned $150. So in all, they still owed us $750. We'd offered them a 2% discount, which is $15 on $750. So we ended up paying them $735. Any questions on these journal entries that we've had to do or on the bank reconciliation that we've done? Anything at all? Okay. The last thing we're doing before we are done here. You have a question? September 14th, September 21st, and September 22nd. Okay, so let's go to September 14th real quick. September 14th, Okay, we had 2 transactions. Okay? So what happened is on September 12th, we sold goods of $900. Okay? We sold goods of $900. Those goods cost us $600. So we are recognizing the sale and as well the cost of that sale in one time. So that's what we're looking at on the 12th. On the 14th, they returned those goods. So for the first place, we sold it to them for $900. So when they returned it, we had to reduce the amount that they owed us by that same amount. Okay? Now what happens is we don't just reduce the inventory for 150 because the inventory actually cost us something different. Okay? So like you were looking like here in the purchase, it's something different. The amount that I paid is the amount that I owe for it. So when I return something, however much I owe and I paid are the same. When I have a sale, I've marked up the price. I bought it for $100, but I'm going to sell it for $500. Okay? So, or like they did here. It cost me $100, but I'm selling it for $150. And that's what you're recognizing. The difference between what your sale price is and what the actual cost of the good is. And that's what you're also doing there. So here you're saying I'm selling it for $900 even though it only cost me $600. So when they return it, because they're returning one, they reduce what they owe me by $150. Okay? But the actual cost of that inventory was only $100. So that's what's happening on September 14th. You're recognizing both the reduction in how much they owe you and the reduction in the cost of your goods. Those are 2 different things. Okay? Okay. So, any other questions? Number 21. Okay. Number 21. September 21st says, we paid Danny Co. for the purchase. All right. So like these are for purchases. So September 6th, 10th, and 21st are all for these purchases. Okay? So what happens is we are purchasing based on the cost principle, or we're recording based on the cost principle. The cost principle tells us that we must record our assets, our inventory, etc., at the cost of, at the amount that it cost us. When we purchase it on September 6th, we do not know whether we will take advantage of the discount. We've been offered it, but we don't know whether we'll take advantage of it. So we record it at the full amount we would have to pay for it. We returned whatever on September 10th, so that reduced the amount that we owed. Okay? So that's still the amount of inventory we have. We had $1,400, we returned $100 worth, we have $1,300 worth of inventory. Okay, we have $1,300 worth of inventory. Now when I pay them off, they give me a 3% discount. So I am paying off, I've come to pay off that $1,300, but they told me I only have to pay them $1,261 and the balance is clear. Well, if I only pay them $1,261 and my balance is clear, how much did my inventory cost me? $1,261. How much is my inventory recorded at? $1,300. How much should my inventory be recorded at? Why? We work off cost principle. I must record it at the amount that it cost me. How much did it cost me? How much did it cost me? $1,261 is what it cost me. How much do I have it as being recorded as? $1,400 minus 100 is, did it cost me $1,300? Did it cost me $1,300? No, because I paid for it within the discount period. What's the difference between the $1,300 and $1,261? $39. I'm reducing the inventory for the amount that it cost me, to the amount that it cost me. That's the process that you're going through in that journal entry. Okay? And that's why it goes for the purchase that you put it to inventory. Because you're trying to get your inventory at the recorded at the cost, whatever it cost you. So initially you do it, it's $1,400, it's fine, great. We return something, okay, we owe them less. Now I'm going to pay it off. I'm paying you all off. You're giving me a discount, so I need to reduce my inventory for that amount. And another way to think of it, I owe them $1,300. I reduce my inventory for the amount that I've been discounted, and I pay the difference. My cash is the difference. Okay? Does that help? Layla? Okay. 22? This is sales. Unlike in inventory where we have to record the amount that we purchase, the goods that we purchase at their cost, these are for sales. Sales we are recording at our markup. So we recorded our sales for $900 at a markup price. That's our selling price, $900. When we returned things, we did the $150. We reduced the amount that they owed us. Now it's just knowing the journal entry. Every time we give a sales discount, there'll be a debit for sales discount. You have to make sure you remember that for sales. If I'm offering a discount, the debit is sales discount. Besides that, they're paying off their accounts receivable that they owe me. They owed me $900 minus $150. They owed me $750. They've come to pay it off. I offered them a 15% sale or 2% sales discount, which came out to be $15. And so in all, I collected $735. It is very straightforward when we're doing the sales. How much cash did you receive? How much did you offer them as a discount? And how much did they owe you in the first place? Very straightforward. Okay? Any other questions? So, next questions, or last three questions ask us, what amount would RIA report as net sales in the September income statement? What amount would RIA report as gross profit? And what is the gross profit percentage? What's the formula for gross profit percentage?
Net sales divided by gross profit.
Not quite.
Gross profit divided by net sales.
Gross profit divided by net sales. Okay? Multiply by 100 to get the percentage. Okay? So we're going to say, what amount would RIA report as net sales? How do you calculate net sales? No, sir. How do we calculate net sales?
Sales revenue.
Sales revenue minus our sales returns and allowances and our sales discounts. That is your total sales. I sold it for $900, but I gave you a return for $150, and I gave you a discount of $15. How much did I end up selling? $735. I had sales revenue of $900, but I gave them a return of $150, and then I gave them a discount of $15. So in all, I had net sales of $735. Okay, net of returns and returns, allowances, and discounts is what net sales means. Okay. What amount would RIA report as gross profit? What is gross profit? Net sales minus your cost of goods sold. Gross profit is the one where you take in cost of goods sold. Okay? So net sales, $735 minus cost of goods sold, which was $600. We reduced it by 100, so it's now $500, gives us $235. Last question, what is the gross profit percentage? What are we going to do? Someone tell me? Okay, gross profit over net sales. 235 divided by 735 gives us just about 32%. Any questions at all? Okay? This section is really about the journal entries. I encourage you to make sure you memorize them if you have to, so you are not lost on what the journal entries are. Because then from there it's easier to do the calculations if I know what my journal entries are. If I know that when I do a purchase, it's going to be inventory and accounts payable. I know that, and it's just an amount. If I know that every time I do a sales, if I offer a sales discount, it's going to be the cash I receive, a debit for the sales discount, and a credit for the accounts receivable. Then I have to go back and figure that out. Well, the accounts receivable is the full amount that I'm owed. The sales discount is the amount of the discount, and the cash is the difference. Okay? When I'm doing a payment on a purchase, it's pretty much the same except the exact opposite. Where accounts payable is debited, my inventory is credited as opposed to sales discount, and my cash is credited because I'm paying out myself. So I get an accounts payable for the full amount that's owed, I debit that, I credit inventory for the amount of the discount to reduce it by that much, and then cash gets the difference. Okay? So I would highly recommend making sure you know these journal entries. Know them. Okay? They are just some general ones, as I've told you, with the accruals and deferrals. It's just every time it's a deferral, you'll have an expense to be debited if we're doing an expense, and one of those assets, either prepaid rent, prepaid insurance, prepaid something, or supplies. Okay? And then when it's an accrual, it'll always be an expense and a payable. So if I'm recognizing expense but not yet paying, expense, payable. Okay? When it's revenue, a deferral is just recognizing the unearned revenue that you collected earlier, whereas an accrual is recognizing the work you've done and haven't been paid for. Okay? Keywords on accrual is have not yet billed or collected. And keyword for the deferral with the revenue is that it is you have unearned revenue that was earned this period. Okay, if you don't have any other questions, that's the end of this test review.